Okay, so the first thing we were asked to do is prepare a monthly budget estimate of cost of goods sold. So the first thing you want to do is find the planned production costs. So for January and February, we took the planned production units and multiplied that by the rates for direct labor, direct materials, and variable manufacturing overhead. So direct materials was $2, direct labor was $4, and variable manufacturing overhead was $3. So I multiplied each of those numbers by the planned production units for January and February. So for January it was 100,000 units, in February it was 150,000 units, and that's how many units were produced. And so I multiplied each of those, and also I added in the fixed manufacturing overhead, which was given to us, and it was $600,000 per month. So once I added that all up, I got the planned production costs, and so for January it was $1,500,000. And for February, it was $1,950,000. So after you find your total cost, you're going to want to find your per unit cost. So to do that, you take your total cost and divide it by the planned production units. So for January, I divided $1,500,000 by 100,000, and that got me a per unit cost of $15. And then for February, I took $1,950,000 and divided it by 150,000, which gave me $13 per unit, a $13 per unit cost. So after that, you want to find your units sold and units in ending inventory. So to do this, you have to start with January. You have to do all of January, and then you can do all of February, because you have your ending inventory in January is equal to your beginning inventory in February. So the beginning inventory in January, it told us was 50,000 units. So we started with 50,000, and then you want to add in your goods manufactured, which in January was 100,000, and that gave me 150,000 units or goods available for sale. But then you also want to take out the number of units that you sold. So for January it was 125,000, and so we got an ending inventory of 25,000. And then you're going to take that 25,000 and make it the beginning inventory of February. So in February, we started with 25,000 units. We produced 150,000 units, which gave us 175,000 units or goods available for sale. And then we took out the number of units sold, which was 100,000, and we ended up with an ending inventory in February of 75,000 units. So once you do that, you can finally figure out your estimated cost of goods sold. So this is basically taking your units and finding how much they cost. So you start with the beginning finished goods inventory for January, and you take your beginning inventory, which is $50,000, and you multiply that by $16.50, because that's what they gave us. That's what the paper told us. They were $16.50 each. And that gave us $825,000. Then you want to find your cost of goods manufactured. So in this, you take your planned production units for January, which was $100,000, and you multiply that by your per unit cost, which is $15. And so that gave us $1,500,000. Once you add those together, that gives you your cost of goods available for sale, which for January is $2,325,000. After that, you want to subtract out your ending finished goods inventory. For this, you're going to want to take your ending inventory for January, which is $25,000, and multiply that by your per unit cost, which again is $15, which gave us $375,000. So after subtracting that from the cost of goods available for sale, that gives you your cost of goods sold. So our cost of goods sold for January ended up being $1,950,000. So after you do January, you can do February, or you can just do them at the same time. It doesn't matter. So again, we start with the beginning finished goods inventory. We took the $16.50 given to us and multiplied that by our beginning inventory for February, which is $25,000, and that gave us $412,500. And then for cost of goods manufactured, you take your per unit cost, which was $13, and multiply that by your planned production, which was $150,000, and that gives you $1,950,000. You add those together, and it gives you your cost of goods available for sale, which was $2,362,500. You subtract out your ending finished goods inventory, which you find by multiplying your per unit cost and your ending inventory, giving us $975,000, and ending with your cost of goods sold of $1,387,000, $387,500. So that gives you your cost of goods sold. Then we are asked to plan an operating budget for January, February. So the first thing you have to do is find out your sales number. So we start in January again. It says that we sold 125,000 units, and you're going to want to multiply that by the unit price, which was $25. So that gave me $3,125,000. Then you're going to want to subtract out your COGS. So for January, it was $1,950,000, and that gives us our gross profit of $1,175,000. Then you want to take out your selling and administrative expenses. So our fixed expenses were $200,000. Then for the variable, it told us that it was 5% of sales. So we took our original sales and multiplied that by 0.05 to get $156,250, and you subtract that out to get your income before tax, which is $818,750. Then you're going to take that number and multiply it by the federal income tax rate, which is 30%, and that gives us $245,625, and that gives you your net income of $573,125. And then you want to do that for February as well, so you do the same for sales. Since we sold 100,000 units, multiply that by 25, you get 2,500,000 units. Then you take out your COGS, which is $1,387,500, and gives you your gross profit of $1,112,500. Then you take out your fixed and variable expenses, doing the same as we did for January, giving us an income before tax of $787,500. And you take out the income tax expense of 30%, and it gives you your net income of $551,250.